Hello everyone, thanks for watching. Today I'm going to give a quick overview of how I watch the energy markets whenever I'm in a position that's exposed to either like the discount rate, maybe I have a pure interest rate speculation, or even just positions tied to volatility like options, which still have sensitivity to energy markets. So first of all, I want to say that if you go to like a charting software, and you look at crude oil, etc., and so on, that's just a very, an easy, intuitive energy up, inflation pressures up, energy down, inflation pressures down. That's not really what I want to go in this video. Like I want to show like the actual nuances within the energy markets because there's a lot more information that needs to be observed than just simply what is the spot futures on oil. So one of my favorite pairs to watch is actually the Brent crude pair, or Brent minus crude, so the BZ contract and the CL contract. And what that can show you is the premium for international oil. And what I mean by that is the CL, the crude oil contract, WTI, is more tied to American markets, and the BZ market is more tied to international markets. Now, there's nuance there. It's not exactly perfect, but what you can see in situations whenever you have the same contracts is, for instance, look what happened when the Iran situation happened. I'm going to pull up a daily chart, daily line chart. You had the premium for an international barrel of oil go for about $3 on the contract all the way to 14.41. Why did it increase? Well, that increase is a sign of geopolitical risk premia in the international contract. And that's something very important to consider. So when you watch Brent minus crude, what you're essentially looking at is you're looking at the premium paid for international risk, and the higher or more expensive the same month Brent contract is on crude, like we'll just use, I'll even just use the September of this year for both of them. This just rotates through the front month contract, but we'll even just keep it on one contract. So you can see if we look at the September Brent minus the September crude, you can see the premiums built up. Even though the outbreak of the war was in March, you actually saw the premium build up with kind of geopolitical narratives, media narratives around troops, around arguments within the two governments. You saw premium on that September barrel of oil, and to mid to late February increasing. And if you are somebody with interest rate exposed positions, for instance, if you're trading the yield curve, maybe it's time to start hedging for an inflation shock when you see international premiums on Brent increasing. Conversely, around May 4th and 5th, we started a downtrend in the September contract. You can see that the premium was at $10.46 a barrel for Brent, and now it's all the way down to $3.58. And what this shows you is the risk premia of international oil, like I said earlier, and that's very key to predicting, analyzing, and hedging international geopolitical risks. For instance, if you want to take a position on this pair, if you wanted to take a position to say, I think I want to hedge myself from international oil and its risk, you would buy the pair. And what trade that would give you is that would buy one of the Brent and sell one of the same month crude. And you could do the opposite and make a speculative position against that. And I actually find this incredibly helpful because of generally how tied energy stress is to international geopolitics. The next thing I like to watch is the crude oil curve. And what this curve shows you, if we can get to the product depth here, is it shows you a natural crude oil curve you can see there's it goes down over in time. There's not any quote unquote natural crude oil curve. I'll show you my Excel spreadsheet where you can actually make use of this, but basically students, I'll get the file here. What you could do to make sense of this is you would have to compare the contract to its ideal curve, because that crude curve you see, it's all about storage cost, risk premia on there, but you're also going to have to do some regression on it because there's just financing. It's tied to dollar funding rate. And let me see if we can get this. I apologize for the wait. And I'll pull up this Excel file. And what this shows you, and this is for bonds, but the concept I want to show is when you compare the contract, you would have to compare to, this is the image that matters. This one's for a cheapest to deliver situation on bonds. But the concept I'm trying to stress is you need to understand the market curve of the futures versus its ideal curve. So what you would do here is you would overlay the oil futures with an ideal curve at the spot SOFR, and you would look at it, does it trade rich or cheap? So you're not just looking at the shape, which the shape kind of has it regressing to 66. You would look at the richness or cheapness of it, and you could see how much premia is being paid. And I did some analytics on this the other day, and it's actually the massive risk premia, as kind of shown by this Brent crude spread. It lessens significantly, and the market's kind of reverting to pre-war conditions. It's still priced. There's still premia from the risk on the table, but people are now kind of shorting that premia with talks about the war ending. The next thing I like to watch is actually just spot natural gas. I know I said I wouldn't be talking about spot prices on a chart, but spot natural gas is kind of your it's your black swan trade. And what I mean by that is if you look at stuff like Volmageddon in 2018, if you look at other such instances where you have especially equities, options tied volatility shocks, natural gas can really show you that. For instance, that nat gas shock around January, that, if I am correct, let's look at the dates on this, the 20th, there's probably if we pull up our VIX index for the same time period, if we pull up there, look at that. Even though it's not a huge shock, you can see the VIX index shot from 15.4 all the way to 21.07. And you got to remember, even though this looks small compared to bigger shocks, when volatility on the S&P jumps from 15.45 all the way to 21.18, that's if you're a short options trader, that can actually be what knocks you out. And you can actually see that move. Now, I don't remember the exact causes of it, but if you were watching the natural gas contract, when you started seeing natural gas break out, if you're a short volatility trader, you might want to close those positions, maybe even switch to long ball, because natural gas, and I don't have the exact mechanics for it, unfortunately. I need to probably study more into that, but it can always be a canary in the coal mine for volatility shocks. I'll even look at the 5-year minus bill yield. And I'll even see if there was a yield curve kind of shock around that January 20th event that would impact people trading bonds. And you actually see, look at that, around that same time period as well, if I can pull this up, there was even a little steepener in the bills to 5-year. And what that kind of shows you is it wasn't just one event. I'm not saying natural gas led the way, but if you're a bond trader and you're kind of trading a flattener, you might have seen a steepener shock. If you're a vol trader on the VIX, you would have seen that little pop in the volatility index. And what was your sensitive beta to that? The most sensitive instrument to capture that I've seen for that little January 20th shock was that kind of natural gas run up. And that's why I also watch the spot price of that. And it's not really in an academic way, but if it's trading, you can get some significant insight into just little micro liquidity shocks in the natural gas contract. Another thing I like to watch is the RBOB gasoline curve. If we go here, and what this kind of shows you is doing the same logic as earlier. Like I showed, you have to compare it to a fair value futures curve. But the RBOB gasoline futures is key insights if you're an inflation trader into what the CPI, especially for the consumer energy, that can give you a big insight into that on how rich or cheap or even the directionality of the RBOB gasoline futures. So for instance, if you're trading a bond calendar, like if you're short the front month ZN and you're long the next month, you are sensitive to repo, you are sensitive to inflation outlooks, and you might want to be watching that RBOB curve because this is very heavy into what consumers in the United States, especially because we are a driving car economy, feels, and it might tie the Fed's hands in like some action they'd have to make. And if I had to like do a quick like multi-chart overview, what I like to do is like if I'm just watching price action, all I need to watch is Brent, crude. Let me just go to the charts function real quick. So all you need to watch is Brent, crude, nat gas, the RBOB gasoline, and heating oil. Heating oil is kind of, especially around winter, it can be significant. There's some nuances to that I've learned, but I don't know as much about heating oil, so I won't comment on it. But you can kind of see like different shocks, and obviously the oil and gasoline and heating oil economy trade similarly. And why I stress that watching the nat gas contract is important, as you can see here in this clean example. Nat gas can have its own independent moves. I'll even pull up a 3-year weekly chart on each. And even though they're all quote unquote part of energy, you can watch nat gas kind of has its own narrative and agenda. So if you're stuck at only watching the oil and oil products, you might miss some volatility shocks that nat gas will warn you about. And then finally, I'm going to add an overlay of the energy sector, XLE. And you can see as well, energy trades closely just with the spot products of energy. Like when there's that oil shock, you can see the energy sector. And then when oil sells off, you can see the energy sector sells off. Now there are some moves that are kind of more independent, like this. This was tied more to the stock market crash. You could see April and March of 25. What was this move? This move was the tariff-based stock sell-off. So if you do watch the energy sector, you need to understand that it's not just within the energy ecosystem. You can have completely equities-led sell-offs that will tie into it. And that's kind of your nuance of an energy trader if you add XLE in. But overall, just one more overview, my ultimate favorite watch within energy is the Brent to crude premium. You have to use the same month contracts for it to be clean. You wouldn't want to do like this September 26th and then just do like a December 26th. It's still going to kind of be the correct directionality, but that's kind of getting into calendar plays. Premia over time, which it is a real thing to watch. But if you're trying to like make it simple for a desk trading tool. There might be more information than you'd want in there. Watch the energy curves. Always make sure to add an ideal curve if you're on an Excel overlay, because you wouldn't want to just simply be looking at just the shape of the curve, because that's not enough information. That's not going to tell you if it's rich or cheap. And then if you want to watch just charts for price action, I'd recommend the 6 charts of BZ, Brent, CL, crude, NG, nat gas, RB, the RBOB gasoline, HO, heating oil, and the XLE ETF, which is the energy sector. And the final note is, if you are kind of trying to trade the energy sector with ties to the energy markets, you might want to watch that XLE drop. Where could you have seen predictors of that? You could have probably, you'd need to be watching equities too. So let me get rid of this. Yeah, if we go back here, where is that sell-off of 25? It's right here, and you could see like there. So if you're watching the SPX, you would have some plenty of warning time before that drop right there, because the entire S&P index has already taken a nosedive. And that kind of shows you that you don't want to get just sector specific. You want to have a holistic view. You want to be watching rates, corporate bonds, Forex, energy, and whatnot, so you can have a nuanced and hedged position. And that's pretty much it. That's my overview of how I personally watch the energy market. I hope y'all have a great rest of your day.